Welcome to Richfield Hybrid Learning. Today's topic will be the accounting cycle. Remember, we did the nature and purpose of accounting, and we also did the double entry system. Now we will be looking at the accounting cycle, the sequence of the accounting procedures that is followed during the accounting period when recording the transactions. Today's objectives of this topic, we will be looking at the definition of the accounting cycle, and from the definition, we'll look at the source documents. From the source documents, we will go to the journals. And from the journals, we will go to the ledger accounts. From the ledger accounts, we'll look at the trial balances. And from the trial balances, we will also look at the financial statements that must be prepared by the business during the accounting period or at the end of the accounting period. Then lastly, we'll look at the ratio analysis. Let us look at the definition of the accounting cycle. This is the sequence of the accounting procedures and accounting principles that must be followed when recording the transaction during the year. What will happen is you will get a transaction. You should be able to identify and analyze and summarize and classify the transaction where it belongs. So this is the core of the accounting process, where you are analyzing the transaction and putting them according to the relevant journals, and also posting them into the ledger accounts, and also preparing the trial balances up until you do the financial reporting in terms of the financial statements. Those financial statements must be analyzed and interpreted in terms of ratios. The summary of the accounting cycle is to analyze and measure the financial transactions in the source documents. From the source documents, you'll be able to record the transactions in the journals. And from the journals, you'll be able to post the transactions into the ledger accounts. From the ledger accounts, you will prepare the trial balance. And from the trial balance, you will be able to prepare the financial statements. After the financial statements, you will be able to analyze and interpret the financial statements. Let us look at the source documents. What is a source document exactly? It is a document that proves that the transaction took place. It is the original record containing the details to substantiate a transaction entered into accounting system. And all source documents must have duplicates. And examples of source documents will be receipts, invoices, cash register slip, petty cash voucher. Okay, we said from the source documents, you record the transactions into the journals. We have different types of journals, which is cash receipts journal. Cash receipts journal, you record all the amounts received by the business. And we have cash payments journal, where you're recording all the payments made by the business. And you also have what is called petty cash journal. Petty cash journal, you are recording whatever transactions that were done using petty cash. This might be internal transactions and also external transactions. We also have what is called sales or debtors journal. In the sales or debtors journal, you are recording only the credit sales made by the business. Only the credit sales made by the business. Then you have purchases or creditors journal. Purchases journal, it's where you are recording the credit purchases made by the business. You will record that in the creditors journal. Then we have what is called sales returns journal and purchases returns journal. Sales returns journal, it's where you are recording the returns by the customers to the businesses. When the business sells goods on credit to their debtors or to their customers, and they find that those goods are damaged or they delivered the wrong items, when they return them, you record that in the sales returns journal. And we also have purchases journal, where the business buys goods from the supplier and they realize maybe the goods are damaged or they are of the inferior quality. The business will have to return goods to the suppliers by putting the transaction in the purchases returns journal. Then we have the general journal that covers all the transactions that do not fit in any of the above journals. From the journals, you move to the ledgers. In accounting, we have three main components of ledgers. We have debtors ledger, we have creditors ledger, lastly, we have the general ledger. What do you record under the debtors ledger? It groups all the accounts related to the customers that bought from the business on credit or where the business sold goods on credit to. So whenever the business is selling on credit, they're selling to the debtors. So that's where you record in the debtors ledger all the transactions related to debtors or to the credit sales. You record them in the debtors ledger. Same thing applies with the creditors ledger. Whenever the business is buying from the suppliers on credit. So whatever transactions that occur there, you need to record them in the creditors ledger. Then we have general ledger, which is centralized compilation of all the ledger accounts in the business. It consists of all the elements of financial statements, which is assets, liabilities, equity, income, and expenses. Whatever account that is affected, it can be recorded in the general ledger. From the ledger accounts, you can post into the trial balance. What is a trial balance? It's a summary of all debits and credits. And trial balance is divided into two sections, which is the balance sheet account section and the nominal accounts section. Under the balance sheet account section, you will find assets, liabilities, and equity accounts. Under the nominal account section, you will find income and expenses. And we have three types of trial balances that we will be dealing with. It's a pre-adjustment trial balance and the post-adjustment trial balance, and lastly, the post-closing trial balance. Pre-adjustment trial balance is a trial balance before considering the adjustments, whereas post-adjustment trial balance is a trial balance after considering the adjustments. Then we have post-closing trial balance. After doing the closing entries, you will get a post-closing trial balance. What does that mean? It means income and expenses under the nominal account section will be closed off. When you are closing them off, you're closing them off against the trading account and also against the profit and loss account. Once you close them off, you will find what is called post-closing trial balance. Once you have the pre-adjustment trial balance and the post-adjustment trial balance, you are able to prepare what is called the financial statements. There are 5 sets of financial statements that must be prepared by the business at the end of the accounting period. We are looking at the statement of financial position, the statement of profit and loss and other comprehensive income, the statement of changes in equity, the statement of cash flow, and lastly, the notes to the financial statements. The final step of the accounting cycle is ratio analysis or analysis and interpretation of the financial statements. How do you analyze and interpret the financial statements? By using the accounting ratios. The accounting ratios, we are looking at the subset of the financial ratios, which are grouped into 3. And those groups of ratios, they will measure the efficiency and the profitability of the company based on the financial statements. The profitability ratios, we are looking at what brings profit to the business. How profitable is this business? Then we have solvency ratios or leverage ratios, where we are comparing the long-term liabilities and the long-term assets of the business and also the equity part of the business. Then we have liquidity ratios. The liquidity ratios, those ratios, they measure the ability of an enterprise to pay its short-term obligations when they arise. So remember, we said the transaction starts from the source documents, from the source documents to the journals, from the journals to the ledgers, from the ledgers to the trial balance, and from the trial balance you are able to prepare the financial statement. And the final stage is where you are analyzing these financial statements in terms of ratios. That brings us to the end of our accounting cycle.